It's Friday, 7th of December, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, China, big in electric vehicles, still big in carpets. Why China's factories are upending the EM development model. But first, Neil Shearing, Group Chief Economist, is back with me again to rake over the coals of another week in macro and markets and another week in Trumpland. Hi, Neil.
Hi, David.
Yeah, we're less than 3 weeks into this presidency, and I've calculated there's 195 more to go until the next election. I suspect we will have a lot to talk about, but I wanted to ask first, what have we learned so far? It's been a weird week. Perhaps it's just a usual week in Trumpland, but one thing I've learned is it's probably best to stop reading the news altogether. If we can't do that, give us an update on whether or not we are in a global trade war. If it came and went with those Canada and Mexico tariffs being on and then being off and China facing slightly higher tariffs, where are we at the end of this unusual week?
Yeah, I mean, you joke about not reading the news, but there's a grain of truth to that insofar as there's a slight danger that we overreact to some of the headlines that we see or overinterpret some of the statements that are made by the White House. And trace just one example of this, where we saw big statements made this time last week about tariffs being imposed on Mexico and Canada and China, and then, of course, a deal with Mexico and Canada subsequently being done at the 11th hour to roll those back. Now, where does that leave us is your question. I think, broadly speaking, there are lessons there, not taking everything that President Trump says at face value. The first is that he's clearly willing to do deals, and we've now seen tariff threat on Colombia, Mexico, Canada, all three countries rolled back at the 11th hour once those governments have been able to give him a win, so to speak. So potential for deals to be done. The second is it could be significant that the US carried through on the tariff threat against China. It's notable that Colombia, Canada, Mexico are all long-standing allies of the US. China, of course, is not. We've talked about how the US and China are in this new era of superpower rivalry, and significant that the tariffs on China went ahead. The cabinet, of course, although not all confirmed, is chock full of China hawks. And then the final lesson from the last week is if you look at the response of China to those tariffs, I think it really echoed what we had expected countries to do when tariffs were levied upon them by the US, which is to say, respond, retaliate, but do so in a way that's calibrated not to escalate the situation. So the US placed tariffs on about $450 billion worth of imports from China. China's tariffs in response is about $20 billion of imports from the US. So you could just see the difference in scale of that response. So 3 lessons there. Deals are possible, possibly some significance in the fact that Trump followed through on the tariff threat on China, but not on long-standing US allies. And in response to those tariffs, China's retaliated in a relatively modest and limited fashion. So those, I think, are the lessons for this week. Of course, this time next week, there could be a whole new different set of lessons. And therein, I guess, lies the risk.
That's it, isn't it? Because, yes, deals were done, tariffs averted. Still a big question about what the point of the whole exercise was in terms of announcing these tariffs. And there's always a temptation, isn't there, to try and rationalize moments like these and say Trump playing 3D chess and the markets aren't seeing the bigger picture here. But then he suddenly blurts out a plan to redevelop Gaza, and you're reminded that this is policy being made on the fly, and that there's a trap, isn't there, that for all of Trump's appetite to get deals done and to be seen as a deal maker, that there is a complacency around these expectations of how far the president's willing to go and how far he isn't.
Yes, I think that's right. I think that you've hit the nail on the head exactly. That I think there's now a pretty broad sense in markets that the US will make big, bold threats, but when push comes to shove, most, if not all of those, will be rolled back and diluted. The risk, of course, is that they're not, and that the Trump administration does follow through on some of those threats. So there's this sense in markets that Trump is bluffing and maybe willing to do a deal, but there's a risk that if he doesn't, you get quite big market moves. And even if you don't get market moves, the threat itself could have unintended consequences in terms of how other countries respond or retaliate in the face of that threat. Yes, I think there is a slight danger of complacency in markets, even though I do think the lesson of the last week is that deals are there to be done.
Nonetheless, 2 key deadlines to watch for: March the 5th, when this 30-day period for Canada and Mexico runs out. Then I presume Trump will either make a decision to impose those tariffs or perhaps there'll be another 30-day period, more reviews. And then the 1st of April, where we have this sweeping review of US trade relations, including, I think, a look at the permanent normal trade relation arrangement with China that's been in place for the past quarter century. It would appear that we're in a kind of holding pattern at the moment. Markets seem to be fairly calm around all of this. But as we move towards these deadlines, presumably attention is going to start focusing again.
Yes, exactly. And there's a risk, of course, that we come to another cliff edge where he takes one or two statements from the White House saying, oh, Mexico's not giving us what we want, or there's no agreement. Then we'll get the leaks to news wires, won't we, and news outlets about how both sides seem to be far apart. And it's easy to see how you get another rally in the dollar, sell off in the Canadian dollar or Mexican peso. So I suspect, yes, this could just be a temporary reprieve. Now, that's not to say that we're going to get big tariffs imposed on Canada and Mexico at the end of this process, but just that I don't think it's going to be a smooth glide path through to a renegotiation of the USMCA trade agreement. I think most people will accept there's going to be some pretty big bumps along the way.
And also, I suppose we should always remember it's Trumpland. Who knows where we will be come those deadlines. He may have announced plans to annex Croydon by then. You mentioned earlier about the fact that Trump didn't impose tariffs on his allies. He did impose tariffs on China. And that speaks to this idea that we've been developing over the past few years about how the world economy is fracturing into US-led and China-led blocks. And actually, we spoke last Sunday, we talked about how Trump is a threat to the cohesiveness of this US-led bloc. But there are lots of countries, even within these two blocs, that are unaligned, that aren't aligned with China and aren't aligned with the US. They've been deliberately trying to balance the US and China, avoid buddying up with either of them. And they're being actively courted by these two countries. Trump's making it much harder for these countries, some of them in Southeast Asia, to say no to China. So talk a bit about what we've learned in terms of this fracturing process and the risks to this fracturing process from events of the past week.
I think the big picture still stands, which is to say, firstly, the key dynamic here is between Washington and Beijing, the US and China, and that reflects all the points that we've talked about, superpower rivalry and so on and so forth. That, I think, is the key and overriding issue. And then the second point is that yes, you're right. The danger is that the US is starting in this fracturing process from a point of advantage, relative advantage over China because of the size of the bloc that allies with it, but also the economic diversity within that bloc. And the risk to the US is that a more belligerent approach, adversarial approach towards its allies pushes them away, or just makes other countries reluctant to ally with the US because they think it may be an unreliable partner. And it's interesting you mention Southeast Asia, because I think that's a part of the world where we start to see some of the real life consequences of fracturing come to bear. So in defense terms, of course, the South China Sea, lots of contested claims over territory there by China that pushes it into conflict with long-standing US allies such as the Philippines, but also in economic terms, countries like Vietnam have been major beneficiaries of US-China fracturing so far, because when manufacturing has moved out of China for geopolitical or other reasons, it has made sense for Western firms to set up in Vietnam, access to this big network of Asian manufacturers plugged into global supply chains. And if you look at Vietnam's performance over the past several years, how its share of global exports has exploded since the middle part of the last decade, it underlines the point about how fracturing really can reconfigure trade relations and transform economic prospects for some countries. So this idea of fracturing is a framework for thinking about how the global economy is going to develop over the next decade or so in the context of this US-China superpower rivalry. The re-election of Trump will test that framework. I think the framework kind of bends rather than breaks, though. And that's been the main lesson from, albeit only the first couple of weeks of this second Trump administration.
Let's get on to more immediate matters, because we've just had January payrolls, the January employment report from the US. 10-year Treasury yield spiking, big numbers there. Talk about what we learned about the state of the jobs market in January, but also what happened at the end of 2023-24.
Yes. So in the January employment report of each year, we get these so-called benchmark revisions where the BLS goes back and it makes adjustments to the assumptions and the weights that it places on the surveys, the survey data to get to the aggregate number. So we've just been through that process. And what that does is that it makes it quite difficult to interpret just the January numbers in isolations. So what did we learn? As a result of these benchmark revisions, the level of employment in the US was revised lower, but not by as much as many had feared. And also, if you look at the back end of last year, the US appears to have been adding jobs at a slightly faster rate than was previously thought to be the case. January itself, the payrolls number was a bit soft, 143,000 gain. That may be due to weather-related factors, and of course there's wildfires in California, although the BLS itself said it didn't think that was a major factor. Set against that, though, the unemployment rate down to 4% now, and an average wage growth up. So where does that leave us? I think it's still a labour market that's in pretty good shape, to be honest. Unemployment low, wage growth pretty solid. The labour market's probably not as tight as was the case, say, 18 months ago. And if you look at the kind of quits rates and some of the vacancies rates, we've had JOLTS data over the past week, the job openings rates, they're coming down nicely. But the labour market itself is in a pretty healthy place. So I think all of that, allied with the tariff threats and uncertainty that we've just spoken about, means that the Fed's probably on the sidelines for the time being.
And I know you say 143,000 a bit soft, but relatively speaking, that's a pretty nice number, isn't it? And it feels like it's just more US economic data that contrasts with what we're seeing in Europe. We've been noting this divergence between the fortunes of the US economy and what's been happening in Europe. Talk a bit about that in light of some of this recent European data and the messaging actually out of the Bank of England yesterday.
Yes, it's really striking, isn't it? You're right. We had the messaging from the Bank of England, but also some activity data from the Eurozone. Today, we're talking on Friday. German industrial production in December down just over 2% in the month. Okay, that followed a pretty healthy gain in November. But take a step back. I was talking to our chief Eurozone economist, Andrew Kenningham, earlier. By his estimates, German industrial production now is back to the level it was in May 2020, which was the height of the pandemic. So remarkable economic weakness from Europe's major economy. And then, yes, here in the UK, 2 members of the MPC voting for larger 50 basis point cuts to interest rates this week. Although if you look at the broader communications around that and what other members of the MPC were saying, not quite so dovish. But certainly the case that the growth backdrop in Europe is very different from that in the US. Signs that the labour market's cooling more rapidly, and on the activity front, a lot weaker.
And just squaring that circle, that's going to be a very difficult backdrop for European policymakers if they are going to have to engage with Trump on tariff negotiations.
Yeah, hugely difficult, partly because of the uncertainty effect created by tariffs themselves. I wouldn't want to overdo this. I think a lot of the analysis that draws relationships, for example, between measures of trade uncertainty and GDP, I think confuses sometimes correlation with causation. Often it's the case that trade uncertainty increases because the economy is weak rather than the economy is weak because trade uncertainty has increased. But still, it's not helpful if you're a business thinking about expansion plans or what you should do with investment or employment. So there's that element, but also policymakers in Europe have got to weigh this weakness of economic activity against the fact that services inflation in many parts of the continent is still pretty high, pretty sticky. So, as I said earlier, there's evidence that the labour market's cooling. Certainly hiring intentions have softened a lot in Europe, but that's feeding through only very gradually to wage growth and therefore to services inflation. And the longer that continues, I think that the more difficult it is to escape the conclusion that actually Europe's just trapped in this low growth environment for structural reasons. And of course, against that backdrop, there's not much that interest rates can do to revive economic growth. So that's the major challenge, I think, facing European policymakers, is to try to come to a judgment as to how much of this growth weakness is demand related and cyclical, can be addressed by lower interest rates, and how much of it's structural. And frankly, there's not much that monetary policy can do on that front.
That was Neil Shearing on Europe's struggling economy, more on the trade war and the latest US employment numbers and implications for the Federal Reserve. We've got more on that Europe-US divergence question with a drop-in. That's one of our short-form online briefings this coming Wednesday after the January US CPI release. And that's going to be all about the differing inflation stories in these economies. Then on Thursday, our commodities team are doing a session on the issues relevant to commodities markets that have come up since Trump returned to office, including drill, baby, drill, but also what's happening with gold, soft commodities, etc., etc. I will add links to both of those sessions to the show notes. On Trump, there's more analysis to get to grips with what's happening, including what his administration's steps to slash the US overseas aid budget means for emerging markets. That's a hot topic. I'll add that to the show notes too, but don't forget our dedicated Trump page is where you can find all of the key analysis about what's going on and what it means for the global economy and markets. Now, back to China and new analysis from Leah Fahy from our China team, which draws attention to a little noticed trend in emerging market development. There was a time when emerging economies would industrialize by working their way up the value chain, graduating out of low-skilled, low-wage production, which would then move on to cheaper market. That's been a popular model for explaining how, starting with Japan, Asia's economies have industrialized in turn. But then came China. Leah's analysis shows that even as Chinese firms are dominating high-end manufacturing, so think things like EVs and batteries, which have dominated headlines, it's also been growing market share in traditional low-end sectors, so things like toys, furniture, and textiles. This is unprecedented, and as Leah and Deputy Chief EM economist Shilan Shah discussed recently, it's a massive problem for emerging markets in South Asia and Africa. Here's that conversation now, and I should add it was held before Trump went ahead with another 10% tariffs on Chinese goods.
So we know that China's exports have been booming over the past couple of years. We've seen the country increase its global export market share, and there's been a lot of global pushback as well, particularly about its exports of high-tech goods. So you've seen countries like the US and also the EU ramp up tariffs on things like China's green tech exports, like solar panels, electric vehicles, and the like. But we've recently done some research that's highlighted a far less acknowledged point. When you break down China's exports by good type, it's actually been gaining ground in these lower tech, traditionally labor-intensive goods, as well as high-end goods. So that includes products like toys, furniture, certain types of textiles, and so on. Now, that's really surprising because these are the kind of goods that you'd expect a country to move away from as it started developing further. And that's what you've seen in developed markets as well, and what economics theory would suggest, that as labor costs rise in a country and it gains prowess in higher end manufacturing, it'd move away from these labor intensive lower end goods.
Yeah, that's really interesting because, as you say, the labor intensity of some of those goods that you've mentioned generally means that their production has been dominated by low-income emerging markets where costs are low. I mean, you typically think of places like Vietnam and Bangladesh as becoming bigger players in the production of textiles, for example. I think really there's two questions that come out of this. So one is, why has this happened? And why has China been able to break the mold? And the second question, is this a trend that you think is going to continue?
Yeah, so on your first question, it's really a story of industrial policy and the imbalance between domestic supply and demand. So on industrial policy, it's obviously largely been focused on high-tech manufacturing, but investment in lower tech manufacturing has actually been growing at an increasingly fast rate as well. And there's also been a big focus on automation, which has helped boost productivity in historically more labor-intensive industries. And you've also seen things like the effects of manufacturing subsidies help boost output in downstream industries, as well as the industries that have been targeted by China's industrial policy. And so all of these factors have come together to result in a really rapid increase in manufacturing capacity across most industries in China, not just those higher end industries. And then at the same time as this has been happening, you've seen a real weakening of domestic demand. So growth in Chinese consumer demand has slowed really significantly as income growth has weakened and falling property prices have eroded household wealth. And so what you've seen is this imbalance in between weak domestic demand and a surge in manufacturing capacity. And as an outcome of that, to prevent all this excess capacity from going unused, what's happened is that Chinese manufacturers have slashed prices and made Chinese goods much more competitive on global markets. And that's been true, again, across the board with all Chinese goods of all different technological levels. And so that's what's caused Chinese exports to surge so significantly. And then I guess if we're looking ahead in terms of whether this trend is set to continue, none of these domestic factors that have led to this kind of excess capacity are really set to unwind. We think fiscal support is only going to provide a small and temporary boost to domestic demand, and that investment is set to remain pretty strong in the country as well. However, there is the kind of more global factor. With President Trump now in office, there is obviously a risk that US tariffs on China will escalate pretty significantly, and that there's a more general global shift towards protectionism. We think that might prevent some further gains in China's global export market share, but we also don't think that'll be enough to eat into China's export market share either. So what this all points to is that China's exports are going to remain pretty strong.
Okay, so this has potentially really big implications, I think, for many low-income emerging economies, because essentially it's threatening to kick away one of the most important ladders to economic development, which is the growth of the manufacturing sector. We've looked at the counterparts of this of sorts from India's perspective, and it has been quite striking how its global export share of things like furniture and toys have basically flatlined in the past 7 or 8 years, and its share of global garment exports has actually fallen. So there is a zero-sum element to all of this. Now, I think in India's case specifically, it's probably less of a problem because India has demonstrated another path to development by growing its services exports. But for lots of other low-cost emerging economies in South Asia and in Africa in particular, it's going to make income convergence with advanced economies much more difficult in the future.
That was Shilan Shah talking to Leah Fahy about her new analysis on how China is breaking the industrialization mold and taking market share in low-end manufacturing. I will post her report to the podcast notes. Do take a look. That chat with Leah and Shilan was a short one. I appreciate that. And there's obviously much more to get into. If you want to talk to any of the team about any of the issues raised in this podcast or in their analysis, do speak to your account manager and we can set up a meeting. But that's it for this week. We will be back next week with more on global macro and markets, including the very latest from Trumpland. Until then, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.